And welcome to the continuing programming for Davos Worldwide. Chris and I are going to have a discussion as we wait for Giovanni to join us. So, Chris, we've heard from the Chief Investment Officer for Whittier Trust. We've heard a little bit from the African side. We've heard a very kind of interesting synopsis on the opportunities in the space economy. Keeping in mind, that we have been, monitoring this for a very long time, what are your thoughts so far on the panel?
I think the panels are, as they usually are for these conferences, really, really interesting. I mean, one does not have to believe every single data point, every single item, every single thesis presented by these speakers. Uh, but whether you believe them or not, they're so thought-provoking. Whether it's as simple as predictions about near-term inflation levels and the assessment that we're likely to not hit 2 but be below 2.5 in the US, or contemplations of how we handle ownership of assets in space. They cause you to think. They put ideas into your head. I mean, as you know, you and I have been discussing for a while the impact of AI and robotics on the broad economy, and how we'll talk about this more later in the conference. But generally, this sort of barbell trend between automation and human-centered activities and value creation, it's a big world out there, right? There's so much going on. You can't keep track of all of it. And I think the one thing that you can take away from kind of all these panelists and all these panels and all these topics is you kind of have to decide which belief systems are going to matter to you and point yourself in that direction, surround yourself by the experts in that space, uh, and commit to at least a little bit. I don't know. What about you? What do you think?
It's been interesting just from the 3 panels that we've had so far, where we've had financial experts from around the world. And when you look at a Whittier Trust, which is managing billions of dollars, or you look at a African fund manager slash, entrepreneur slash whatever, and then you look at Tej, who is, a very established person in the space side of it, was the CEO of Axiom, and is now in the process of launching his own fund and his own ventures in the space economy. So you see that there's business and that progress continues. And the one thing that we've discussed quite often is the fact that we have neglected areas still. So while space is sexy and AI is sexy and a couple of other areas are sexy, largely a entrepreneur today who is in that middle market space doesn't really have many options. So what do you think about that?
I mean, that's a nice tee up. It's. I never come here to talk about my company, my main activity at IDAP Global, but that's kind of, as you know, what we do. You're exactly right. You're spot on. I mean, depending on whose measurements you take, at least 50%, and often upwards of 80%. And it does vary a little bit from country to country, but I mean, those numbers could be global, of the world's economy is SMEs, small and medium enterprises. And those people, not only are they the backbone of the economy in every country in the world, they're also the real source of growth. I mean, let's be honest. The $1 trillion ultra mega quadruplex unicorns, whatever we want to call them, coming out of Silicon Valley, yeah, they're huge, but they're not moving the global needle. I mean, $1 trillion sounds like a lot, but it's not that much in the modern world. When you talk about global GDP, world economy, these are big numbers today. Equally, the incumbents, the big sort of manufacturing giant firms of yore, whether they are public or still private and family owned, whether we're talking about the Boeings, the Raytheons, the Mercedes Benzes, the Thales out of France, these companies are huge as well, and they're huge economic drivers, but they're not driving growth. Where growth comes from is the hundreds of thousands, millions of individual entrepreneurs out there incrementally driving growth. It's kind of that classic thing, right? Like you can get $1 million as $1 million check, or you get $1 million as a whole lot of pennies. Now, if you're getting the $1 million, you don't care which way that comes. But if you're a business, you do care. Closing one giant customer is great. But if that's all you close, or you close one and then two or three mid-sized ones, and that big one goes away, you're done. You would most cases of the time much rather have 1,000 tiny customers. And if you lose a customer, if somebody drops off, it's not the end of the world. You can keep growing your business. You're stable, you're steady, you're solid. I think investors do well to look at the world that same way. That, yeah, you can bet on Apple, and betting on Apple is often a good bet. You can bet on OpenAI. Maybe it's a good bet. But if you bet on chocolatiers in 100 different cities, yeah, I'm pretty sure chocolate's not going out of business in 100 different cities anytime soon, right? So that's the way we think about the world at IDAP is real economy, real entrepreneurship, and who's really doing something innovative in that context, and then give them an avenue to grow their business through capital to which they might otherwise not have access. Because if you're that person, if you're an SME, you know, Goldman's not going to take your phone call, and the VCs aren't going to take your phone call, right? So where do you get aggressive growth capital? And that's what we do, absolutely, and I think it's critical.
Right. Especially when you look at that range of companies that are doing that 10 to 50 plus million in revenue. They've got
Mhm.
a positive EBITDA. So they're not good for a venture group because the venture group
Mhm.
can't value that effectively for their returns and will not have the control that they want. They're not studio material. They certainly are a private equity fodder, but they're too small even for private equity to look at. It's just
Mhm.
unless there's something really, really interesting hiding in the assets, in IP or in maybe some kind of land holding. These are just not attractive enough for private equity. Certainly, they're not public, so there's no hedge fund activity. So these
Mhm.
companies tend to be completely in, you know, they're struggling. And the option to them is, well, you could go OTC and you could try that option and you could maybe be successful. I mean, one of the problems with OTC in current markets is that what we're seeing is, the aforementioned large corporations, with their Goldman Sachs, with any of the investment banks, really, they're sucking the oxygen, or in this case, the dollars out of the room. Right.
Mhm.
So when you come to this point, even when you have these very successful SMEs, and they can even be generational and they can be, very strong. They're really, unless they're willing to cede control, whether it's going public and becoming subject to public markets, or
Mhm.
in the worst case scenario, investment with change of control. These are not options that they want to take. So how do you address that?
Yeah, and the point about the OTC markets is well made, and then actually I'd extend it even farther because we see kind of similar problems in this new generation of not public markets but private markets, where we're starting to see a lot of platforms out there for trading private assets and for securitizing assets outside of the public market. Um, and you're right, it's not. You're right, and it's worse. It's not just that the main markets and the main large funds are taking all the oxygen out of the air. It's that what oxygen remains is all traders. And so the minute you list on an OTC, you're done. It is almost impossible for you to be rewarded for additional value creation because everybody's just going to trade your stock up and down and make their profits on the pennies on the incremental exchange. And it's very, very hard to get out of that bubble. And that's worse in the private markets. Um, we at IDAP take a long-term view, and I think that's both from the entrepreneur's perspective, but also from the investor's perspective. So to date, the way we've been handling this is, if you're an investor, as you said, a private equity company, play, fund, or individual, family office, high net worth, may want to come into these deals, but they're often still too small even for them. So what we do is sort of create pseudo bundles where we'll say, okay, Mr. Investor, you want to invest in energy assets in Europe that are at this stage of development and create this sort of return and already have X% of takeoff committed. Yeah? Yeah. Okay. Here are 20 such deals. You write a check across all 20 of them instead of having to invest into each one individually. We've already done the DD on all 20. You don't have to go spend that time, which you can't afford to do for this tiny of a deal individually. Here's the bucket, and kind of roll them up and let people come into almost an asset class, if you will. And that's been our approach to date. But again, as you well know, and I don't want to tease too much of what we're talking about here, but there are some other options we're looking at going forward, how to make that even smoother for the investors.
Right. When we look at capital companies in general, today, you have such a very interesting kind of urgency, and the urgency is built by time horizons, right? So either it's because your LPs are looking for, or investors are looking for some kind of dividend, or are looking for a coupon, or are looking for at least a quarterly return. So managing that is in conflict with managing what is best for the company itself. So when you make the investment in the company, you're basically saying, hey, we really don't care about your long-term growth. Just make sure you have good news in the cycle, and let's keep that going. Is that the future?
Is that the future? I was not expecting that closing to that description. Um, yes and no, right? I think like a lot of things, we're seeing a real bifurcation. Things are going to the extremes on one side and the other. So absolutely, there is going to be a lot of pressure on a lot of companies, as there has been for a long time, to perform on a quarter over quarter basis, to just go after that number. But I think that there is a sizable percentage of investors that recognize there is something in long term value. And it's not just the sort of mythical 100-year plan of Japanese companies. We see this in the Western world all the time of family offices and individuals that say, yeah, I need a return. I wouldn't be investing, if I didn't want a return. That would be philanthropy, and that's something different. I have some cash over here for that. This is for a return, but it's more visionary. It's more long term. What is this going to look like in 10, 50, 100 years? How does it support not my, check at the restaurant next month, but my legacy, my children, my grandchildren? How do I grow and outpace global inflation and currency fluctuations and whatever is going on with crypto that we can't even imagine, and central bank changes? How do I plan for a future that is real, harmonious, and wealth generating and preserving? That sort of permanent capital approach, I think, uh, is a balance to the quarterly over quarterly returns. Like you need both, just like you need AI and robots to really drive value creation on the commoditization side and commoditize more and more and more, but also the human side of the high touch, high personalization, intimate, local, uh, high value world. Like that, everything's going to go to those extremes, and investors will be well served to play on both ends of the barbell. At least that's it.
Yeah, no, I completely agree. I mean, I think that more and more we're starting to see a hesitation from family offices and from asset managers in taking risks that are becoming untenable. So if you look at kind of the AI company model, certainly Google has an advantage. They've got a very robust data business. They've got a very robust products business, as does Microsoft, as does Amazon. But when you look at an open AI, where it's AI for the sake of AI, it becomes a very interesting investment, in the sense of looking at monetization of that investment. So, as we kind of see this trend towards, let's everybody put our eggs in one big basket as opposed to, let's distribute them out. Companies that are such as yours, that an IDAP is providing kind of that medium deal of saying, here's this great customer, they've got an order, they need some money, they need to fill the order. It's what we used to originally call just basic investment, right? Till we became a little bit more sophisticated, and then we got more sophisticated, and at some point we've lost touch, it seems, with basic transactions. What are your thoughts?
Yeah, I think you're absolutely right, and it's almost a natural outcome of the capitalist system, right? So the notion, we forget what money is, right? Money ultimately is an abstraction of human free time. Like that's how it starts, right? It starts when you're in a village somewhere in some prehistoric tribe, and somebody figures out that, hey, if I make a basket, I can carry 10 times as much fruit, and therefore I don't have to spend as much time harvesting fruit. And then that person starts making baskets, and that person is then no longer harvesting fruit, so somebody has to give them the fruit so they get the baskets. And as this grows, you realize, okay, that's great, but like I don't want a whole cow traded for 33 baskets. That doesn't make any sense. We need some way to, allocate our time and divide these assets up. That's what money is at its foundation. And then over the millennia since then, we introduce bankers and contracts and securities and fractional securities and derivatives and bundled derivatives. And yeah, I don't know what like half the bankers in the world do in a sense of how do they equate to trading chickens for cows in human free time. But I'm 100% sure they're actually an abstraction of that at some level. And we do lose touch with it. We lose touch with the real world. And I think the more, it's not that I'm opposed to derivatives or securities or any of this stuff. It's all great. It's great innovation, but it is important to understand what's happening below the level of the abstraction. And when you don't understand what's happening below the level of the abstraction, like that's how we got the 2008 financial crisis, right? I mean, CFDs, nobody knew what was getting bundled up in those. Nobody knew what the aggregate risk was. And these were very smart, very well educated experts in their field across the world who missed it. It's easy to fall prey to, and prey is the wrong word because it's not like somebody was. It's there's no malice, right? But when things are sufficiently abstract and you don't know what's happening underneath the covers, uh, it's easier for there to be unintended consequences.
Right. Which again brings us to kind of what was the original side of this half-hour discussion, which is non-performing assets. We
Mm.
are starting to see an accumulation of non-performing assets, across the board, whether it's in various different segments. Whether, CRE, commercial real estate, certainly is one big concern. There's concerns in other areas of real estate, but then there's also debt. Um,
Mm-hmm.
there was
Mm-hmm.
a time when debt ratios for an Apple or a Microsoft or a Google were very manageable, and they were actually quite
Mm-hmm.
attractive. Today, they are 100% plus into
Mm-hmm.
revenue. So the
Mm-hmm.
thing is, at the end of the day, are we heading into another situation where we're going to see further accumulation of non-performing assets, and kind of the expectation is, well, the government will have to bail it out?
Oh, I mean, to be honest, I wish Giovanni had been here because I was looking very much forward to his talk. I, I don't have a strong opinion on the first half of that. Things come in cycles. We overinvest, we underinvest. There are booms and there are busts. That's a kind of a naturally occurring thing. Um, for sure, you see a lot of sorry, I jumped ahead of my own train of thought there. A lot of companies, but also a lot of countries that have unsustainable debt levels, or at least what appear to be unsustainable debt levels. Um, what does that mean, and what's the timing on that? Uh, that's
Oh, no, no, I'm
outside of
not
my
asking you
immediate
to be
sphere
an
of
oracle.
influence.
I'm just saying, we no longer look at fundamentals, right? We're no longer looking
Well,
at basic fundamentals. When I started my credit training, it was the three C's, credit, cash flow, and character.
yeah, yeah,
So, but and then it was the who, what, when, why, when, et cetera. Kind of, these were basics of saying, this is how we do borrowing, and this is how we evaluate companies, and that got converted into an Excel model, and then the Excel model got converted into a further more complex Excel model,
yeah.
and today, somewhere buried in there are some of these concepts, but they're not so important anymore.
Well, it's all right. So that's actually where I totally disagree. I do think it is very hard for certainly for the retail investor, even a very sophisticated retail investor, but even for many professionals to look at any metric today and decide what's sensible. I mean, if you just look at aggregate PE multiples, it is not at all clear to me how the stock market didn't crash in 2019. Like it has been so overvalued for so long. And guess what? It's just getting crazier. But those are aggregate numbers, right? And if you take out the high flyers, like I don't know what the right PE should be for Nvidia. I'm not sure, but I do know they're distorting their PE is high enough that they're distorting the whole index. And if you get into the details of individual investments in individual companies, you forget those metrics at your own peril. Like they absolutely still matter. And it is a mistake to think they don't. And it's a mistake that, quite frankly, happens at least every generation, if not every decade, right? We see it time and time again. It happened in the 80s, it happened in the 90s, it happened in the aughts. Like people will think, oh, this time is different. Economics don't matter. It's never different. And even when it looks really, really different, if you get back to that foundational core of what is money and what are people doing, like are these automation systems, these robotics and these AIs that radically change cost propositions going to mean everything's different? Yeah, no, they're not. They're going to enable a whole bunch of stuff. They're going to be incredibly wealth generating. They're going to create so much value, but they're not going to change the way the world works at a fundamental level. That's nobody's changing physics, right? That's how that's how things are.
No, no, absolutely. And I think, and the reason I bring that up is because I think that kind of ties back to exactly what we are talking about in an IDAP focus, or in the way we look at things at J Capital, and the way we have been kind of conversing about the need for um, a focused vehicle that is looking
Mhm.
at this particular segment, keeping in mind basic fundamentals, keeping in mind not looking at unicorns, and
Mhm.
necessarily great if they become one,
Mhm.
but not
Mhm.
necessarily looking at it from a let's hunt the next unicorn philosophy, which seems to have taken over, at least in tech,
Mhm.
and more real business, real people, knowing the fundamentals. Is this a good business? Are they good managers?
Mhm.
Is this a industry that can survive? Is it cyclical? Is it, just basic stuff? What are your
Mhm.
thoughts?
Yeah, and I think you're absolutely spot on that that's a place we've been paying a lot of attention broadly. So that way of looking at things, and something that comes up a lot in these conferences, and that is kind of near and dear to my heart, but also kind of not. And I say these things at my own peril, I guess. But there's a lot of talk about impact, and there are a lot of people out there trying to do things that are impactful, whatever that means. I personally believe much of that work should just be charity. It should be philanthropic endeavors. That if you actually want to have an impact, not just on individuals, but on the world, the single best way to do that is to have investment and companies and activity in Human focused, successful businesses that drive wealth at the lowest levels. I'll give you a classic example that I always look back on. This actually might still be true today, but I haven't checked recently. It definitely was true as late as the mid 2000s. So, Google was already 10 years in business, Facebook was already up and running, and it was still true then. Which company had created more millionaires than any other? Nobody ever gets this because you think, well, maybe it's Microsoft, maybe it's Google. It's not. Well, it might be now. It was not that. UPS, United Parcel Service,
Absolutely.
simple logistics company, right? But their success was driven both by their innovations in the big brown truck and how they handled routing and all these things, but also in how they handled their people and how they compensated their people. And so they had great customer service, exceptional customer service, and their employees were rewarded for that. And it built in this sort of virtuous cycle. Nobody talks about these things anymore. We don't talk about virtuous cycles. We talk about virality. We talk about moats. I mean, those things are interesting and important, but they're not impactful. They don't make the world a better place. And if you can find those businesses that are genuinely humanly impactful, that's how you get real growth, real value creation in a lasting way. Um, so yeah, and there are so many opportunities out there like that. It's staggering to me. Every day I run into entrepreneurs who are running extraordinarily successful businesses, making 5, 10, 15, 50 million a year in revenue, growing aggressively, great numbers, and have a vision of how they can do it even more. They just need the capital to make that happen. Like
And I
finding
think we
those
should,
people. Yeah,
yeah.
go ahead.
And I think we should look at that, and we should do
Yeah,
something like that. And but just for those of you that are watching, this is not a one-off. We typically tend to have these conversations 24 hours a day, and this is what makes us all good friends. So yeah, so thank you so much, Chris. I'm gonna get off. I'll let you end this panel, and I think we are ready for our next panel, which is AI and innovation.
excellent. As always, great chatting, Anand. And yeah, he's not kidding. You should see my WhatsApp time logs of when we're talking. We definitely have these conversations all the time.